producer of this drug is joining us. We're joined by Shailesh D Siroya, who's the managing director of the company. Thanks a lot, Mr. Siroya, for joining us. First up, could you give us a sense of how much will it impact your domestic market, or how much will your domestic market share improve? Because the numbers that we have, 35% of your sales come from domestic markets, and after the imposition of this anti-dumping duty, how much do you think your domestic share can go up?
Currently, we were supplying about 15 to 20% of the domestic market, and Chinese imports were about the balance 80%. We should be able to cater to the bulk of the requirement of the Indian market. So another about 40 to 50% can be offered by us into the market.
So what does that mean in terms of your revenue? Can you tell us that last year, considering you did about 150 odd crores, could you tell us, 180 odd crores rather, could you tell us what your revenues in this year would be?
In the coming quarter, maybe we should be able to add about at least about a couple of crores. But for the next year, we anticipate a good total imports into India would be between about 30 crores. So we should be able to garner between 15 to 20 crores minimum into our share, additional.
Okay, so you're saying that the Chinese imports constituted nearly 80% of the domestic requirements, and now because of the anti-dumping duty, you will be able to capture about 40 to 60%, and that's about 15 to 20 crore for the next year, that's FY17.
Absolutely correct.
Okay. Do you have enough capacity to cater to this increased demand, or will you be upping your capacity now?
We would be adding up also for the future, but right now, immediately, we'll be able to cater to this requirement.
Okay. What about margins on this?
With the anti-dumping duty, we should be able to get a good thing. Earlier, there was competition from China. So now we should be able to get a good return.
Right. So Mr. Siroya, but the inherent risk of import duties, like we've seen in the steel companies as well, is the differential. Now, despite the import duty, what happens is that the Chinese counterparts do reduce the prices, thus making up for the import duty as well. So could you give us the picture of what the difference between the Chinese imports in India is, what the value of that is, and what the differential is, and what happens if the Chinese themselves reduce the prices of this drug?
Currently, the Chinese are supplying this product in the range of about $85 to $87, and the import duty which has been put on is about $18 on one of the manufacturers and $20+ on the other manufacturer. This is a substantial amount, so for the Chinese to lower whether their costing would permit might be difficult. So I don't foresee much of price erosion from the Chinese on this product yet.
Is this anti-dumping duty permanent? What would be the time horizon? Is there anything like that?
This is a 5-year period for which the anti-dumping is there, and then subsequently the damage is still there from the Chinese player, then it could be renewed further.
And what percentage of your total sales currently account for this drug?
Almost close to about 40% of the company in terms of both formulation as well as the API comes from Gliclazide.
Okay, Mr. Siroya, we'll leave it at that. Thanks so much for joining in. So that's the benefit that the anti-dumping duty on Gliclazide from products from China will have on Bal Pharma, close to about 15 to 20 crores in FY17. It's an important product for Bal Pharma, and now they will be able to cater to the domestic market as well. But that's all the time we have for you in Midcap Radar. Your stocks when we return.